Welcome back, my friends. The news today is that return to the office is dead. A prominent Stanford economist says the U.S. is stuck with remote work as more offices sit empty. Is the bell tolling for commercial real estate? The great post-pandemic return to office, RTO, is a polarizing issue in the U.S. labor market. While many companies want their workers to return to the office for at least a few days a week, seeking better communication, increased productivity, and a return on investment, ROE, for their expensive office real estate. The reality is that Americans like working from home, WFH, and the flexibility it provides. But before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And before we continue, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school, as well as any kind of job that requires a government license or certification. And ProWorldNet.com also includes short-term gig-type jobs as well. So be sure to check out ProWorldNet.com if you are looking for a job or an employee. Employers seem to be coming to terms with that fact, after a big push in 2020 to 2022 to bring employees back to in-person work. When the number of days U.S. employees worked from home dropped from 61.5% to more like 30%. The RTO trend stalled in 2023, according to data from Stanford economics professor Nick Bloom and his team. WFH levels have become flat as a pancake, he recently posted on X. Return to the office is dead. Here's why this employment trend is having an eerie impact on commercial real estate across the country. The data shows that in November of 2023, the percentage of U.S. employees who are working remotely or have a hybrid working arrangement is sitting at just under 42%, and has been sitting at roughly that level since 2021. Many bustling hubs are now starting to look like ghost towns, as office occupancy in the 10 largest U.S. metro areas has been hovering at around 50% this year, according to Castle data. We are 3.5 years in, and we're totally stuck. It would take something as extreme as the pandemic to unstick it, Bloom recently said. Office vacancies on a national level hit a 30-year high of 18.2% in the second quarter of 2023, according to CBRE data, with empty offices or ghost towers cropping up from coast to coast. This is a major driver in the overall dive in office property values, an important metric for real estate investors. Shifting office demand could result in a 35% plunge in office values by the end of 2025, according to a recent report from Capital Economics. It also projects that those values are unlikely to recover before 2040. CBRE's forward-looking analysis is slightly less grim. It expects the overall office vacancy rate to peak and the average rent to bottom out in late 2024. Continued uncertainty about long-term hybrid working arrangements and concerns about the economic outlook are causing many tenants to delay leasing decisions, the firm explained in its 2023 U.S. real estate market outlook mid-year review. Although vacancy rates likely will remain structurally higher in many markets, active tenants in the market suggest that leasing activity will eventually rebound and support the start of an office recovery once economic conditions. Not only have office vacancies reduced foot traffic in the office-adjacent economy, impacting local businesses like restaurants, retailers, convenience stores, and hair salons, but it has also dulled investor confidence in the sector. According to CBRE, commercial real estate investment volumes fell by 64% year over year in the same period. But all is not lost for commercial real estate investors. With the support of the Biden administration, lawmakers in cities like San Francisco, New York, and Washington, D.C. are taking actions to convert vacant offices, hotels, and other non-office commercial spaces to multi-family residential properties. This, they hope, would revitalize their downtowns and address the long-standing supply shortage and affordability crisis in the U.S. housing market. But commercial to residential conversions are not always straightforward. As a top aide to New York Mayor Eric Adams told Yahoo News, those are really hard projects, noting that there's a lot of red tape around zoning laws and design challenges. It is important to understand the scale of these projects too. CBRE noted, while 2023 is shaping up to be a banner year for office building conversions to other uses like residential, they account for less than 2% of total U.S. office inventory. Still, if these conversion projects prove successful, This could be a major boon for residential real estate investors, with opportunities through avenues like residential real estate investment trusts, REITs, exchange-traded funds, and crowdfunding platforms. Emptying office buildings bring back memories of mall failures. Inflation in the new era of remote work is creating a global commercial real estate apocalypse, where zombie properties sit vacant, and owners with loans coming due hand their keys back to lenders, according to experts. The apocalypse that's facing commercial real estate at this moment is all about interest rates and debt maturities. Harold Bordwin, a managing director at Keen Summit Capital Partners, a New York firm specializing in assisting distressed properties, told the Post. Even if you have a building that had all of the same tenants and all of the same income it had 3 years ago, if your debt is maturing today, you have a real problem, Bordwin added. While these spaces don't skimp on the square footage, the inflation wave that crested at a 40-year high last year and remains raised has owners scurrying. In addition, the Federal Reserve's continued tightening to reach its 2% inflation goal has increased the returns on risk-free government bonds, forcing commercial real estate investors to demand more yield to simply justify holding the physical asset, Bloomberg reported. The proof is in the vacancy. Just last week, the owners of downtown San Francisco's largest shopping centers abandoned the lot after 20 years. Unibail-Rodamco Westfield said late on Monday it will transfer its Westfield San Francisco shopping mall to lenders as the shopping center continues to face declining sales, occupancy, and foot traffic. Commercial real estate owners in hubs like New York, San Francisco, London, and Hong Kong are handing keys back to lenders for properties worth less than the debt secured against them. U.S. offices are also plagued by emptiness, prompting landlords to hand keys to their properties over to lenders that are worth less than the debt secured against them, according to Bloomberg. Earlier this month, a study released by economists from NYU Stern Business School, Columbia Business School, and the National Bureau of Economic Research showed that vacancy rates are at 30-year highs in many American cities. In New York City, the vacancy rate was an eye-watering 22.2% in Q1 of 2023. The study predicted that rates would plunge even further later this year as prices are certain to go down the drain. Lower values means less tax revenue. In the case of the Big Apple, the paper predicted a 6.5% drop by 2029. To plug the hole, cities will raise taxes and fees in other ways, making the city less attractive to live in, which means even less revenue. San Francisco, a hub for big tech, meanwhile has already seen companies like Salesforce, Tesla, and Oracle, among others, taking their leasing dollars elsewhere. When Salesforce, a software company that's San Francisco's largest private employer, has made 3 separate announcements since 2020 of plans to slash the office space it owns in the city. The consequences have been devastating for the California city, where office workers accounted for 72% of the area's GDP, $531.28 billion in 2019, before the pandemic. Bordwin said lenders are going to be faced with the choice of pushing mark-to-market or extending and pretending. Mark-to-market was a tactic used in the savings and loan crisis of the 80s and 90s. Bordwin told the Post, where stress debt was cleared by asking, "Who will buy this at what price?" Harold Bordwin, a managing director at Keen Summit Capital Partners, said lenders will choose between pushing mark-to-market or extending and pretending, tactics that were used to crawl out of the 80s and 08 financial crisis. Things were sold at pennies on the dollar, and regulators made their way through that inventory, he said. Another option would be the extend and pretend tactic that was used during the financial crisis of 2008, where borrowers take loans, allowing banks not to think about what collateral is really worth, Bordwin explained. However, there is just a massive amount of obsolete space, the real estate expert said, noting how the pandemic shifted the way of the workforce to remote and hybrid models. Nobody has a great answer to how that could be dealt with, he added, noting that a portion of these buildings could end up getting knocked down eventually, if they're deemed unable to be converted into residential or lab space. The vacancy problem isn't unique to the U.S. In Hong Kong, home to some of the most expensive commercial real estate in the world, 13 million square feet of office space sat empty in June. In Hong Kong, where gleaming office towers are some of the most expensive commercial real estate in the world, a record 13 million square feet of office space sat empty in June, and 15% of the most valuable space was vacant, Bloomberg reported. But what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.